Hey everybody, welcome to the morning market briefing. It's Tuesday, May 26th, 2026. Hope you're doing well out there. Boys, how was Memorial Day weekend?
It was long. Seemed like a long weekend.
Yeah, we got an extra day in there.
Yep. Ready to get back in the saddle. Been watching futures since yesterday. That's the tough part is futures market's open. Things start getting hot and there's nothing to do.
Yeah,
you know,
just sitting there. Yeah. Extra 50% on the weekend. So it was Martin was out of town, so it was pretty quiet. Just me and Amanda and Hayden getting outvoted on a lot of stuff. We went to a lot of home furnishing stores.
Oh, yeah, that's brutal.
Yeah, didn't have Martin there to back me up and be like, we're not doing it.
Yeah, we're gonna stay home in the rain.
Yeah, we want to play in the rain. What are futures doing right now, Tom? How are we feeling?
We are in fuego. So we've gotten a lot of chatter about a potential deal. There's some talk that maybe all of the entire Middle East will join the Abraham Accords, making it the art of the deal, perhaps. Once considered dead, suddenly maybe back on the table. But the markets are reading this like there's an imminent resolution in Iran. Oil has dropped like a rock. Now it's in the low 90s. The haters and losers, which was starting to feel a little bit like myself at times on the 30-year Treasury being a good idea. 30-year Treasury has dropped from, the high 520s to basically 5% on the dot, which for those, who need the bond math done for you, that's about a 3.5% return pretty much over the weekend. So we should be looking pretty hot on bonds. Interestingly, the 2-year Treasury is up about 14 basis points. So if you're thinking, man, the best place to be is short, you may perhaps have been wrong. But Ben and I were talking that we've staked quite a bit of our professional reputation on the idea that the long bond was a good opportunity. So today at least is a win. We got about 29 years, 364 days to go to see if it pays off.
We'll see how. Yeah, somebody timestamped that so that in almost 30 years, when we're on whatever the new version of YouTube is, we can reference it.
Yeah, but the in the short term, but that shows you the power of the bond math. I mean, a 20 basis point move on the 30-year. If you assume, functionally the average 30-year has a 16 duration, it kind of depends on your coupon. Ones with lower coupons are actually going to perform even more strongly because you've got more of a multiplicative effect of the duration. You're seeing really strong gains. You can see it happen really quickly. If we drop to a 480, we'd be up, low or high single digits and, cruising towards, double digits pretty quickly. And so that's really the thinking there. But, if we get a resolution here, we see oil prices drop and stay down. This thing could drop, in the 475, 460 range. It could happen really quick. If we go back to call it a 399 in the 10-year, we'd be cooking with gas for the rest of the year on fixed income.
So the way to think about that is the duration is for every 1% move, that's how many percentage moves you get out of the bond. So if the duration is 16 on a 30-year bond, then you're talking for 1% move, 100 basis point move in rates, you're getting a 16% move in the underlying price of that bond, which again, if you scale that down, it means about every 6 or 7 basis points, you're getting a percent move. Bang.
Yeah. Every 25, you're getting, 4.
Yeah.
So not bad.
Plus
you're getting that, the income is there too. This is just principal change.
Not bad at all. Ben, the details of the war and how would you assess the likelihood of us actually getting this deal done?
Well, I think the market's pricing it appropriately right now, which is to say that, yes, things are doing well this morning, but the markets are not pricing in an all clear scenario. And I think that's the important thing. I think if we do get an all clear, I think there's still more upside in a lot of these trades that we're talking about because there's a lot of doubt regarding the phases. First of all, we thought we were going to get a deal maybe on Sunday, as early as Sunday, and then it was kind of Monday, and we're kind of 95% of the way there. Basically, the idea would be open the strait immediately. I don't know if there wouldn't be a toll, but maybe there's revenue for navigation services,
but not a toll.
There's the U.S. would lift its blockade on Iranian ports, but bottom line is, oil would be flowing. It just might come at a little bit of a price, but again, at $92 a barrel, no one's concerned about $1 a barrel, even if it was that much. And then the phase 2 would be kind of agreement on nuclear and sanctions relief. So we'll see what happens with all of that, but I think the big takeaway is there are more signs that there is at least a tendency for both sides to want to get a deal done, and the Iranians know that in order to get a deal done, they need to play ball on the Hormuz Strait, and I think that they're ultimately going to.
I have a question, Ben, and we texted a little bit about this over the weekend, but prior to the breakout of the war, we had an insanely broad market where, for the most part, tech was lagging. Almost everything else was up, leading the markets be up. Bonds were hot. Do you think if we get a resolution, we move back and away from, Mag 7, chip stocks, ASML, Micron, all these sort of stocks that have been on fire for the last 6 weeks while everything else is sort of languished? Do you think we'll go back to a broad market, bonds are hot, less tech heavy market? Or do you think that maybe the fuse has been lit for the next leg higher in the AI trade, and we'll just kind of continue to go that direction?
I think the AI trade will continue. I think that some of the focus might shift as to where's easier money to be made. I do think, however, that we're going to have to digest some of these oil prices. I think that there's still going to be these jitters about inflation that's going to hold things, and I think Kevin Warsh is going to have to be careful about going too early, even if he's seeing some weakness in the economy. So I think that all of those things are still there, but I think that people need to be able to take a little bit of a breath before kind of diving in, especially if you think about consumer discretionary sectors or housing. I think that'll take a little bit more time. But I do think, if we can have some level of stability for a few months, that people will generally forget about that. And remember, inflation is measured, yes, on a year-over-year number, but it's also measured on a month-over-month number. And the month-over-month, if we start to see oil prices going down, we just set the high water mark in May or April. Yeah, whichever you prefer. But regardless, we've said it before, one or two more high inflation prints, and then we start going down. So the question is the market going to be paying more attention to the month-over-month numbers, or are they going to be led by some of the journalists out there who are still talking about the year-over-year numbers in order to further a narrative?
Something to think about, too, in the second Trump era is that the number of things that spook the markets and then we don't think about it all anymore, it goes so quickly. We've been focused on Iran for an unusually long amount of time.
The cycle's been much longer than I would have thought.
You go back to when we killed Soleimani, when you think about the initial discussions with North Korea the first time around, it just, everything happens, even the Butler thing, people don't talk about that at all anymore. The fact that somebody tried to storm the White House this weekend, that was not on the news really at all. It was on Twitter for an hour, and everyone's like, oh, well, another guy tried to shoot the president and ended up dead, Saturday,
Yeah, so things move so fast.
So I think if there's any sort of deal on this, it'll just be gone. It'll be a fart in the wind. And it's wild because we spent, 45 days, 60 days on this now, but if there's some sort of peace deal, it'll just be gone.
We did hear from Warsh on Friday. Any big takeaways for you, Tom?
No, I think it's we're in a show me situation now. Let's see what he can get done. I'm interested to see how quickly he can get the narrative going on. Hey, we need to look at real data. Hey, we need to look at what's actually happening. I wonder if I was him, I would be almost like the new manager that comes in that it's just a pain in everybody's ass because he wants you to actually do work. And I think that would be beneficial because I think that Jay Powell kind of came in with here's what I want to do. I'm going to tell everybody what I want to do. And then everyone's kind of going to vote and be on board with me. And we're just going to keep moving. I think he's going to be like, hey, I want some actual discussion. I want you to come in with reasons. And I think he's going to be very much having his own playbook where he's like, this is the data I'm seeing. This is what I think is important. And hopefully get some actual chatter and discussion going on the FOMC, because I think it's just been a rubber stamp situation for decades. We've seen a little bit of break of that as people sort of try to jockey for either, political clout, looking like a superstar because you're going against Trump, or looking for clout because you want Trump to pick you to be the next guy, or you're Steve Moran and you just want to, watch the world burn a little bit and just do whatever you want to. And so I think that is positive. We've talked a lot about the Bank of England and how they almost never are in agreement. I think that should be how the Fed should be, and I think that he hopefully gets that sort of discussion going where there are multiple thoughts on what exactly is going on with the economy, and they come to a logical conclusion about what to do based on that, rather than just being like, I don't know, man, the data seems okay, we're just not going to do anything. We don't know. That was a lot of Jay Powell's like, I just don't know, so I'm not going to do anything.
It's so interesting to me how the Federal Reserve itself as an entity has evolved over the decades, in that I think when it was first constructed, it was done, and you get all these representatives from these individual Federal Reserve banks across the country, all providing input to come up with the best decision. But now it seems like everything's done so centrally, and the data is so uniform. We all look at national data. It's not like they're saying, well, in my district, we want lower interest rates. And so basically what you were doing back then is we only have one currency, but we have many different economies in this
And there was
country.
real advocacy for regional interest.
Right. And so like what might be better for the Farm Belt might have been worse for the financial belt in New York. And so, that there is some real debates there, and they weren't collecting national data to the extent that we are today. And so they were having to really report. And now it seems like everything's happening so centrally. I almost wonder if the Federal Reserve, and I'm just thinking out loud here, would be better served having the chair make like, hey, it's a new regime now. Like you bring in a new manager, bring in a new coach, and they get to bring in their OC, their DC, their staff, versus kind of having to change the culture when the people existed under the previous regime. It's an interesting question to
they can't clean house.
And it seems like it's almost been like that everywhere. Mm-hmm. In all facets of U.S. society, it's all about the national level. I mean, I feel like in the 90s, there was no discussion of like the mayor of Atlanta actively fighting the president on policy. And it seems like we almost need to get to a point where, maybe that's globalization, where it's like countries have now become entities interacting with each other, and it's like dispersed the power in some way. Because it's almost like if you wanted to improve LA, which is effectively turned into a giant cesspool, the best way to do that would be to focus on LA and not to focus on your interactions with how the president is operating at a national level.
Yeah.
But it seems like almost every city has gone the opposite way. Mm-hmm. I mean, even in the reverse, where it's like, we're going hard to work with ICE because we like what the president's doing, as opposed to be like, does that benefit our city specifically? There's none of that anymore. And it seems like, that would be the most logical thing to build from the ground up.
And that seems to be a specific, and I don't even mean this politically, but that seems to be a specific response that really heightened under Trump.
Yeah.
I think Trump, given his personality and the things he says, the way he acts, the people that he calls out, similarly, has put everyone at a stance where it's like, well, I need to either be a pro or anti-Trump mayor, school board candidate.
I almost think it goes all the way back to W.
Yeah,
It's almost like because that was like the first, like, I'm wearing a W sticker, like I'm a, and like they're like, that was the first. I feel like that was the first "not my president" thing.
Yeah,
like I don't remember people doing that aggressively with Clinton, but I do remember it with W. Bush, and I think it's almost like things used to be so quaint, and now it's just like we're just firing off on all cylinders. Ultimately, what the president does has very little to do with you, assuming you're here legally. I mean,
I think one last comment on this. I think it's interesting when you dovetail that with what Jamie Dimon talked about the implications of AI. He made the point of, I don't know when we were building roads, like when we built the automobile, that we just thought that the automobile would actually give rise to the mall, like the suburban mall.
Yeah.
And it's like, what has the internet given rise to that we might not have expected? And it's kind of to that point, that dissemination of knowledge, like all of this stuff, is everything's so nationally and central now. And so the question then is, okay, what are some other implications of AI? I mean, we can all see the shark closest to the boat, but what is AI going to enable?
What's the mall?
Yeah, it's almost the internet is. I'm closer to my people I follow on Twitter than I am to my neighbors, and that makes you more socially disconnected to your actual physical space.
It's interesting to think about.
Yeah.
I don't know that it's necessarily inspiring. It's a little bit dark.
Yeah.
I don't know how you break the cycle.
Well, it's like one more piece, and I read an interesting piece, which was interesting. That was like, it was an argument for AI, where it was like, the invention of the automobile didn't destroy horses, but what it did is free them from labor, because it's like, there were more horses than people, and horses were a work, they were a tool for doing work and for navigation, and then the invention of the automobile essentially made horses a recreational, for the most part, animal. They're no longer just being beaten all day and made to do work. They don't do very much work at all anymore, and so maybe that's AI for people.
We're the horses.
We're all actually going to be freed from labor.
Yeah, and once a year we're going to race, and everybody's going to watch it.
We're just going to drop horse piles all over the road. Unless you're downtown, you have to pull a carriage, in which case it didn't help anything with those horses.
No.
Their lives actually probably got way worse.
Way worse. Wall Street Journal noting that the risk premium for holding stocks over bonds is disappearing a little bit. Not a surprise given the tone of things that we've talked about on this very call. The question is, how long does that stay? And I think that's the interesting thing to think about, because it does seem like it is handicapping the situation in a way that, hey, this will be the new status quo for stocks and bonds on a relative basis. And I don't think that's necessarily the case.
I don't think so either. I think it's an unbelievable opportunity. I feel like I've said it every call for the last 6 weeks, which is just, stock market's up a lot. It's a great time to trim stuff, get your allocation back in order, buy cheap bonds while they're cheap, and just continue to raise the floor on portfolios, because how much money you're going to make on that bond, assuming no default, and it's just going to, you're just front-loading future returns at 2/3 of what the average stock market return is.
The interesting thing about this story for me was that it was really written under the guise of, we need to sell stocks because they're really expensive relative to bonds. But it didn't really go into much detail about, should you be buying bonds?
Yeah.
And I think that's something that people are unwilling to step out on so far.
And
I'm curious to see if they
in the market in general,
Yeah.
people don't know about bonds. That industry died 10 years ago, and there aren't any people in it anymore, and the knowledge is not there.
Mm-hmm.
It's just it was a dead space for a decade, and now the obvious thing is on the wall, but they don't know how to do it.
Last thing for today, Eli Lilly out with early trials on a drug that people were hype about on X. I haven't seen people on Twitter getting hype about a drug like this in a while, but potentially revolutionary for folks that have high LDL cholesterol.
Yeah, I saw this first on X, actually, and then I started looking into it a little more detail. It's a really good therapy, pretty much no side effects, and you get one shot and boom, your LDL cholesterol is 60% lower, which is your bad cholesterol. And so that's really, really good. It's about as effective as good statins if you take a statin every single day. So I think for maybe some older people, I think that you might just continue to take the statin. But the thing is, taking a statin for 60 years or 70 years is a lot different than taking a statin for 10 years or 15 years or 20 years. And having one shot and not having to worry about cardiac arrest because of your LDL cholesterol could be really game-changing. And the important thing here, and this is, right now Repatha dominates this space, but this would be better than Repatha. Again, this is just phase 1 trials. It's going to go to phase 2 trials. So we only have a sample size of 35 people. But no major side effects, and they kept the LDL cholesterol at those levels for 18 months. So really, really good effects there. I think the bigger takeaway for Eli Lilly, if I'm trying to figure out what that next thing is, because this is about a $4 billion a year opportunity based on the sales of Repatha, Amgen's drug. But the bigger idea is they can go in and take one letter out of that DNA sequence and replace it, give you a shot, and be ready to go, versus some of the other gene editing technologies now. They'll go and they'll try to change one of those letters, but it'll destroy the double helix. So that the whole integrity of the DNA is therefore rendered less integrous, which means that you could have some real significant unintended consequences when you mess around with your DNA. So this just takes out that one letter, replaces it, and then you're off to the races. So I think this would be very good for Eli Lilly if this happens, not just because of this drug, but the implications beyond.
Good stuff. All right, we will wrap it up there. We'll be back tomorrow. Hope you guys have a great day. Talk to you soon.